Volatility does seem to be the only constant in the crypto universe. And in recent weeks, the total value of the crypto market has been as high as $2.6 trillion and as low as $1.4 trillion. All of these dramatic moves are driving record-breaking activity on digital asset platforms. With us now is Meltem Demirors. She's Chief Strategy Officer of CoinShares, which just reported its first ever quarterly results as a public company. So, Meltem, it's good to check in with you. And again, we're probably a little more familiar with CoinDesk over here. CoinShares is kind of a big European crypto wallet. Tell me about the activity that you guys are seeing and what's been happening with the crash here in crypto the last few weeks.
Yeah, thanks so much for having me today. So at CoinShares, our business is really comprised of two primary activities. Around 40% of our revenues in Q1 came from asset management. We have Europe's largest digital asset-focused ETPs. Those have been trading in the market since 2015. So we had $6 billion at the peak in May. Today, we're around $4 billion there. And then we also have 60% of our revenue in Q1 coming from our trading capital markets activity. There, in Q4, we were doing about $1 billion month in turnover. The first quarter of this year was really active. We're trading in futures market. We take a risk neutral approach to trading, do a lot of lending and fixed income. So Q1 across the board in our business was exceptionally busy. We saw a lot of inflows into asset management products, but we also saw a lot of activity in trading. And as Kate alluded to, on the trading side, it's really less about the price of Bitcoin. It's more about volatility. Whenever there's volatility on the upside or on the downside, it's a great time for firms to be in the market. It was extremely profitable for, I think, all firms that operate in that space.
Sure. And I know that your earnings per share are affected by fair value gains on digital assets and all of these kinds of things. But make the case to an investor. I mean, it reminds me a little bit of other commodity spaces. I was just thinking about this today, that over the long run, the price of oil has maybe not been a great investment, but a company like Exxon has been. I'm talking about over a period of decades and decades and decades. Is there an analogy to make between having exposure to Bitcoin or Ether or whatever you want and investing in a company like yours? How are you guys going to provide a better return on capital than somebody who says, I'd rather just own the underlying asset?
Yeah, that's a great question. And that's, I think, one of the great things we have now with our friends at Coinbase going public in Q1, us going public in Q1. There's a lot more data for equity analysts to look at and a lot more opportunities for us to share what's going on in our business with the market. So what we really look at is look at the CME, right? Traditional financial services models are a dying breed. Digitization is happening. Markets are becoming 24/7, 365. Crypto is the first market to do that. But in our view, all markets will be digital, global in nature in the next 5 to 10 years. And we're really well positioned to take advantage of that. We're a technology firm. We build and develop trading infrastructure that allows us to deploy innovative products like our ETPs. But at the end of the day, the big shift that we're betting on and everyone in this asset class is betting on is distribution models for financial products are fundamentally changing. Right? Consumers want more optionality. We see this with millions of users every day logging onto these platforms and trading, again, around the clock, days, weekends, weeknights, weekend evenings. So this is a new paradigm, and that's what we're building for. It's not just about crypto, it's all of Fiserv.
So let me ask you this final question then for everybody who's been watching the price action. Who's driving the selling these days? What do you think is going to be the appetite longer term for institutional demand? Are they buying the dips? Are they maybe actually scared off if they've been following some risk processes to add this into the portfolios? Are they going, you know what, forget it. We'll just kind of take a step back and maybe try again in a couple of years?
Yeah, that's a great question. So again, here I think the trend is, and data that we've looked at from Glassnode in particular, an on-chain data provider, confirms this. A lot of the selling recently has been primarily retail, and a lot of these retail buyers are people who've entered the market recently, feeling skittish, selling, and also traders. There is a huge market maker component to this. There are a lot of firms that are actively trading basis, that are actively trading some of the really juicy ARBs that exist in this market. But again, a lot of the selling is not institutions. When institutions allocate, they're really making a long time horizon bet. They're not entering the trade and then exiting a week later. This is really a process of heavy due diligence, learning, and then allocating with a long-term time horizon.
Right.
So I think this pain is really short-term. There's a lot of very, skittishness generally in macro markets, which we saw, by the way, in tech equities as well. I think as that starts to calm down a bit, we're going to continue to see retail get back into the market. By the way, spot exchange volume is at record highs over the last week. Again, volatility drives activity, whether it's up, whether it's down. That volatility will continue to be a trend for us.
Shepard Smith here. Thanks for watching CNBC on YouTube.